Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, December 16th, 5:28 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the Big Show, the Friday edition of the Revere Market Insight video, where we take a look back at the prior week, take a look ahead at what you need to know for next week, and we're not going to update, but we're going to review the 21 over 21 leaders list. Lot of stocks getting kicked out of there. I've got a lot to add, but I want to do a better job of reviewing it this weekend when there's so many coming out. I mean, I've got a list of easily 25 other stocks that could go in. So not devastation in all the leaders, but devastation in the indexes, and the wind definitely blowing hard in your face, and that's the time to get the heck out of the way, and we'll review that when we review all the charts. So state of the market, downgraded to correction. You can see over here on the trend gauge. Leaders, like I said, still holding up, so we're neutral there. All five indexes now with at least two closes below the 21-day moving average moves that from neutral to downtrend. Medium term, we came off of uptrend to neutral. Multiple indexes breaking below the 50-day moving average. Long term, off of neutral to bearish. Still have the Dow above the 200-day moving average. It bounced there today, but with 4 out of the 5 and the lesser weight that I give to the Dow, we're move that arrow to red. So what happened today? Second gap down after the FOMC rate cut speech and Q&A on Wednesday, when we had a big negative reversal, and we broke below the 50-day moving average on the S&P 500 today. Here are the numbers for the week, the G6 actually for the day, and then we'll go through the week. The G6 down 0.8%. This is our in-house 6 growth ETF composite. S&P 500 down 1.1, NASDAQ down 1%, Dow Jones down 0.9, mid-caps down 1%, Russell 2000 down 0.63, global diversified 60/40 stock and bond down 0.64. We were positive in-house today as our stocks held up pretty well. Our shorts more than offset our longs. We booked some when the stochastics were favorable. We closed a couple of things. We'll take a look at that when we go to the tail of the tape. Let's look at the week now. Clearly not as bad as last week, but it was an outside negative week, meaning we made a higher high and a lower low versus last week. G6 down 2.5, S&P down 2.1, NASDAQ down 2.8, Dow down 1.7, mid-caps down 2.5, Russell down 2.4, 60/40 down 1.7. In-house, we were down 0.38. This is the time when the market is set up in a negative, uh, let's call it risky market. We talk about healthy market and risky market. Trending below all the moving averages and under the 200-day moving average is a risky market. We attempted to break out last week, failed miserably, making basically 4 days down off the high. Very clear that institutions are selling stocks. We get out of the way when we recognize this action. So speaking of getting out of the way when we recognize this action, why do we do this? Because of this. You know this chart if you pay attention to any of our videos. Last 13 bear markets were down over 19% again after chipping our way up to down 14%. Big negative reversal this week. So now we're looking at how low we can go. We've not quite taken back half of that recent run off of October 13th's high, but not a whole lot of support underneath here, and it's very clear that institutions were selling stocks this week. So we get out of the way when we recognize this action. You do not, if you're approaching retirement, you do not want to get caught in a negative sequence of returns that destroys your nest egg, and that's why we make downside protection our number one job at Revere, and the returns take care of themselves when the market turns back healthy. Feels like I've been saying that for about 6, 7, 8 months now, but that's the way we do things. We've had 2 rallies during this bear market. They haven't really gone anywhere. They haven't gotten above the 200-day moving average, which means we're in a risky market and now heading for a recession. Will it be a mild recession? Will it be a deep recession? We don't know. Check out our podcast from this weekend. We go through that spreadsheet that I introduced earlier this week that combines uh, the multiple that the market wants to assign to the S&P 500 along with the earnings that the S&P is going to earn throughout 2023. And it's important to understand uh, how that is calculated, and the first quarter earnings are going to be extremely important going forward. So that's the next benchmark that we're looking at. And if you're interested in an approach like this, where you get out of the way during bad markets, participate in good markets, shoot me an email, don@revereasset.com, or my partner, Dan Stewart, dan@revereasset.com. He's a CFA, master of all things financial. He'll start the onboarding process if you're interested, or you can call 855 Real Wealth. That's 855 732 5932. So here's the S&P 500. Uh, what did we do today? Well, first, let's go back to Tuesday. Great CPI number. Everybody's happy. We're off to the races, right? Nope, a big negative reversal. Then the next day, we've got FOMC. We rallied into that, back above the 200-day moving average. Everything's good, right? Nope. Powell came out. The statement was more hawkish. His speech was more hawkish, and his Q&A was more hawkish. We had a big negative reversal, but still held to 21, so we're going to be okay, right? Nope. Thursday, big gap down at the open, 1.2%, but we held the 50-day moving average, so we're going to be okay, right? Nope. Friday comes, gap down 0.7%, closed down 1.1%, yes, off the lows, but take a look at some technical analysis 101 here. 50-day moving average, 38.64. Let's go to a 5-minute chart. Gap down. Where do we first hold today? The first two spots that we bounced, 39.64. Then we break it. We go lower, 38.36. We try to rally up to 38.51. Make a lower low, 38.20. Make a lower high, 38.45. Make a lower low, 38.28. Okay, that's about as low as we're going to go. Let's rally. We rally up to 38.44, pull back 38.29. Okay, good. We got a higher low now. Let's rally, see what we can do. We spend 20 solid minutes right at 38.65, 38.64, 38.65, 38.64, the 50-day moving average. It was support first thing out of the gate. Then it was broken a little later in the morning. We pulled back, try to get back above it. Now that support has turned into resistance. You can see these bars here, and then we faded a little bit into the close. So off the lows, 38.28 is the low for next week. We tested this 38.28, 38.30 area 4 times today, and that's where it held. But then try to get back above the 50-day moving average, and we tried hard and failed. And so now the 50-day moving average flips from support to resistance unless we can very quickly break back above it. Now, after 4 days down, technically we had a positive close on CPI, but a big negative reversal off the highs. So these 4 days down, we're getting a bit oversold. Wouldn't be surprised to see a bounce, but as I said yesterday, any bounce should be considered an opportunity for you to get out of your longs until the market sets up again, at least stops going lower. And we've got to get some bases of some leading stocks to propel the market higher. A couple of things worked during this uptrend. They really didn't make any significant progress. We stuck to our sell into strength, buy leaders into weakness mantra. That worked out, so. There was a lot of chop in here, though, and we got caught in some of it. From the last time we went to cash to now, lost about 1.8%. But now we're powder pretty much dry, ready. We'll see what this market does going forward next week. Keeping an eye on the lows here. 38.50, very important to understand that 39.50, it should be a brick wall on any bounces up there. Should we get that high, because that was a month worth of support that we couldn't break until we finally broke it on Thursday. You're going to go back here to September. That 3900 to 3950 acted as support before we broke it, acted as resistance before we got back up through it on 1110, pulling back, it held, pulling back, it held, pulling back, it held until it finally breaks. You can only pound on support for so long before you either shoot up way high away from it and it's not an issue anymore, or you break out to the downside. And in this case, we broke out to the downside on Thursday, and we raised a lot of cash. So Nasdaq 100 broke the 21, broke the 52 closes below the 50 today. Here's your champion. Cleanest dirty shirt. The Dow Jones Industrial Average broke the 21, bounced at the 50 and 21. The 200 and the 50-day moving average are kind of bunched up here, off the lows in the upper part of the range. I mean, after 4 days and 6% down, it's time for a little bit of a break, wouldn't you say? Mid caps broke the 21, broke the 200, broke the 50. One closed below there. Small caps even weaker. Uh, Couldn't hold above the 200 early in the week, then broke the 21, broke the 50, 2 days down, bounce at the lows. That's some pretty significant support there at 172, 173, as you can see when you look to the left side of the chart. So um, we'll see what brings next week. RSP, let's go to the equal weighted indexes, bounced at the 50-day moving average. NASDAQ 100 equal weight, still above the 50-day moving average. How about the dollar? Dollar was not up, not a whole lot today. Still trending below the 21-day moving average, hanging out at the 200-day moving average. 2 days off of the lows. Um, really consolidating in this very tight range between 28 and 28.50 for 2.5 weeks. How about the VIX? Hanging around at this 21-day moving average level. Really three tight closes above 21, below 24. It's moving opposite of what the Dow's doing, but it's not showing any significant fear. Imagine how low we will go in the S&P if the VIX does one of these, like it did from August to October. Let's go back to the S&P. What'd that do from August to October? Here's August. Here's October. The Dow can, or the VIX can certainly do that. Right now, there's not a lot of fear into the market. It seems like the big institutions are just trying to assign a probability to how hard the recession is going to be, and is it going to be mild, is it going to be heavy, and what valuation should we assign to it? Multiply that. What are the what are the EPS for the S&P 500 going to be for in 2023, and decide where that's going to fall on that grid that I showed, in the S&P 500. So, and not a lot of fear in that process. Um, where the fear really is past. That was that inflation could not be tamed. Pretty strong hit to the economy from where we were to where we are now, and a pretty big rise in interest rates to tame inflation. But it looks like it's tamed now. The question is, how difficult is the recession going to be? So there's the VIX. Let's take a look at the 10-year note, TNX, uh, down about 1% today. So this consolidating about 3 weeks in this tight area, trying to determine. So you had this range, you broke down, you had this range, we gapped down, we have this range now. So is the next range is just going to put in a low and go higher, or are we going to go lower? These are the types of things that we watch every day here at Revere. Here's the 30-year. Really the same thing, forming a tight range here, still above the 200-day moving average. What did gold do today? It was one of the standouts. It was up uh, into the declining 200-day moving average, bounced off the 21. The dollar, what the dollar ends up doing will have a lot to do with what gold ends up doing. Let's take a look at silver, which was doing very well. Normal pullback in silver within this uptrend in GDX, the gold stocks. Uh, couldn't stay above the 200-day moving average, hanging out there around the 21-day moving average. So junk bonds, how about junk bonds? Any fear in the credit markets? Well, we pulled back for 4 days. That's in line with what the S&P did, sitting on this 21-day moving average. So sitting on the 21 and above the 50, junk bonds are holding up technically better than stocks are. You can see the relative strength line going higher over the past 3 weeks in junk bonds relative to the S&P. So what's next? Let's go to the tail of the tape. As I said, in correction, uh, put call did spike to 1.35 today. That's probably due to some fear about over the weekend and institutions discussing what their next move is going to be, trying to prevent a big gap down next week. VIX still hanging out 2262. Fear and greed down 9. This has dropped 18 points in 2 days, so now it's under mild fear. Off of the bull case now, onto the bear case with the rally failure, break of the 21, really break of all the moving averages after the FOMC. No real headline news today, but I want to point something out. The SPY went ex-dividend today by $1.78. So let's look at a SPY chart. 4 times a year, the SPY at the end of each quarter, the SPY declares its dividends. And you can see here they are last December, March. It's this little blip down in the chart where when you declare your dividend, the SPY immediately gaps down by that amount, and then you compare that to what it's doing relative to the index. You can see here the SPY showing it's down 1.62%. It really wasn't. Uh, 0.45 of this was the gap down due to the dividend. Now, the thing that sucks about SPY is that they wait over a month to actually give you your dividend. If you own VOO, IVV, or SPLG, which are alternatives to the SPY, you get your dividend before the end of the year. I don't know why they do that. It's just a callous treatment of shareholders, frankly. Um, but it does a couple things. It throws off your moving averages relative to where the price is. If you're trying to look at the S&P 500, like today, it's off by 0.45% now. You can see we're showing here the SPY below the 50 by 0.6%. If you look at the S&P 500, it's below it by 0.3%. So give or take that 0.45%. In this case, it's showing 0.3. They don't round it out. They don't take it out to the hundredths of decimal points the way we do, but slight difference there, and it'll be a difference relative to the near-term moving averages until little by little the SPY catches up with the S&P 500 relative to the moving averages just in time for the next quarterly dividend to kick in. So back to the tail of the tape. Day count down 2 3 days, arguably three if you want to go strictly from the high to 3 days down now. I noticed scanning last night and this morning changing character of a ton of charts Thursday. Uh, and that's in line with this breakdown below that 3900 area on the S&P 500. But a lot of charts have been holding support and they gave way on Thursday, followed through to the downside today. Expectations negative coming into today with us being below the 21 and the 200. Add a break of the 50 onto that, which was our support level at 3864 on the S&P. Still held 270 support on the Nasdaq 100. Sectors, gold, silver, and gold and silver stocks up today. Marijuana stocks up. Emerging markets outperformed. ITA, that's aerospace and defense, was up. I think there was a buyout in that industry today. On the other side, on the downside, 11 out of 11 sectors down. Oils all down. The weakest were utilities, real estate, and discretionary. Discretionary because Tesla down 4.72%. That's in the discretionary. Um, and if you think you're safe in utilities and real estate, while the market's going down because they're defensive, utilities down 1.7% today, real estate down 2.95% today. So sometimes there's nowhere to hide. TAN had been one of the leading sectors. That was down 2.3% today. So the focus list is what we own. We'll go over those. Then we'll go over the 21 over 21 portfolio in-house. We took profits at our profit goal, plus 2R, actually it's plus 3R on our financial short FAS. So we trimmed 3/4 of that. We sold half of our SPXL when the stochastics were favorable to us intraday, and we used the bump up in Pi today to get out of that. It bounced at the 50 out of the 21. Underperformed yesterday, outperformed a little bit today, but it needs to finish its base and decide, and the market needs to decide what it wants to do. So really, we're just holding the best of the best of what's left. So bottom line, second gap down since FOMC gave the higher for longer message, and the markets don't like it a bit. So let's go now to the charts first. Our holdings in-house, what we sold today, sold pie. You can see the bounce held the 50 below the 21. It's a volatile stock. It's down from 129 to 111. We had a 2% position in it, which is why I really didn't trim any of it into strength. I guess I could have, but so we bought it on this gap up and really got a whole lot of nothing out of it. Ended up break even trade, so we're out of that. Boeing, our largest position, still 3%. Positive on the day, holding up fine. Held the ADMA, hasn't touched the 21 in a while. Look at the volume patterns, just what you want to look for. Look at the relative strength. This is the type of stock where institutions will go to hide. Also consider that they've had a lot of positive news as far as new orders, and also uh, airlines airlines saying that, and also that they're going to be cash flow positive next year. 5, this held up pretty well today. We trimmed half of this yesterday. It's below the 8. As long as it holds the low of yesterday, we'll give it a chance. We're just barely negative on it, but it did show relative strength today. Mobileye, our gain on half of this yesterday, undercut but held the ADMA today. Let me reset my alert on this. Still holding a 1% position on this. TMDX, still holding our 1% position on this. Alex did a special guest appearance on our podcast this weekend and talked in detail about this stock. It's really a phenomenal product, what they're doing, and frankly has a chance to be something like Intuitive Surgical with their Da Vinci medical breakthrough that basically every hospital has now. I mean, if this is something that every hospital ends up using that does transplants, the market could be huge for it. And they don't really have competitors. FAS, this is where we took our profit running into the 50-day today, but really what we're doing is looking at the XLF chart, 4 days down on it, kind of extended, broke the 50-day when we took profits early in the day on this. Plus, it was coming into this little bit of a support area here. So, and then we have our SDS, which is offsetting a little bit of SPXL that we still have. We sold some of this. And the way we time these is we look at a 5, a 15, a 10, and a 1-minute chart. And when the stochastics are positive, we take a little bit off. So we sold it multiple times throughout the day, depending on where the stochastics were. Why don't we sell it all? Because you could very easily get a big rally here after being down for 4 straight days. And we've got the SDS offsetting it. Basically our adjusted beta now is 0.05 between the longs and the hedges that we have. FAS and SDS offsetting SPXL. So let's get to the 21. Over the 21 now. Again, this hasn't been curated. A lot of these we still own, and then let's see where they are relative to their 21 day. Already looked at Mobileye, Boeing, which we own, 5, which we own. These are all still in there as they're above their 21 day. SARK, we got stopped out of this. That was a tough sale on my part. We sold near the bottom on the gap up, in this case, the gap down on SARK, and it's very much come back. Still looking, I mean, it's doing what it needed to do. I went back and reviewed a couple things I could have done instead of this being the first one to go, and it was either pay me now or pay me later. I could still be in it. The alternative was to uh, add more to the long side or take some off of the short side, but whatever, that was what I decided on. I don't was part of the plan. not the most optimal outcome, but it was part of the plan. All right, Steel Dynamics. We stopped out of all this today. This has broken the 21-day moving average. Some good about this though. Nucor announced, yeah, we're gonna have bad numbers for the fourth quarter. Steel Dynamics got hit on that yesterday. Today they said, yeah, we're not Nucor. Our numbers are fine for the fourth quarter. It touched the 50-day and bounced. When something breaks the 21, I put it on a separate list. Ideally, it holds the 50, starts going sideways, and comes back up. If the numbers are still good and the market's right, we very possibly could buy it back. Um, Next up is Scorpio. This is not acting like there's even a correction going on, still trending higher above the 80 MA. ATHR, another one that broke the 21 but held at the 50. Impinge, we already reviewed that, broke the 21 but held the 50. Celsius broke the 21, bounced above the 50, this 100 area. Remember when that was support back here, then resistance here, acting as support again. And again, this is still a fundamentally great stock being held back by the market. We took our profits around 111, 112 with this. It went higher. This is the day that we took it. It went higher and now it's pulled back lower to where it is. Always like when I can get back in lower on something that I sold when it was extended. Netflix broke the 21, holding the 50 with that big negative announcement yesterday about their ad tier not doing what they promised advertisers it would do. So they're having to give some of their money back. Deckers broke the 21 today, still above the 50. KLA 10 core holding on the 21. ELF, one of the strongest stocks in the market, bounced at the 21 today. GDX sitting right on the 21, a proxy for the gold sector stocks. GFS broke the 50, sorry, broke the 21, bounced at the 50-day. Home Depot sitting right on the 21. UTHR, very strong, up today, 1.13%. This is really one of the uh, very strong stocks out there. Nvidia sitting on the 21. We stopped out yesterday when it broke back below the 200-day moving average. ON Semi breaking the 21 and the 50. This is coming off of the list. And Schwab broke the 21, holding the 50. So a common theme here is not a lot of the stocks that broke the 21 also broke the 50. Some of the leaders are holding up okay. It's the indexes that look like garbage. And stocks that aren't really tied, a big percentage of the indexes are holding up a lot better than the overall indexes are. Um, the big FANG type stocks are just looking like trash. There's Tesla. I mean, that is, if you look up downtrend in the dictionary, there's a picture of it there now, actually. Apple broke 140, broke all the moving averages. Amazon, I mean, they're bringing packages for us every day for Christmas, but maybe I'm the only one. No, I know I'm not the only one, but that's ugly. Trending below the downtrending 21. It's not going to help the indexes because of its size. Google, uh, doing a great job continuing to kick people off because they don't like what they say or do, trending below its 50 and its 21. Microsoft, about the only one that's holding up decently, but it broke its 21 today after failing into the 200-day moving average earlier in the week. Remember Meta when we used to show this all the time along with those stocks? It is 27% below its 200-day moving average with a relative strength of 15. It's trash. And all these big stocks are really hurting the overall indexes, especially the S&P and the Nasdaq 100. But there's a lot of stocks that are holding up pretty well. I sent a snapshot of 30 of them to the gang this morning. I easily have 40 or 50 that could go back into the 21 over 21 list. But they're not. They're there, but they're not making any progress. So why get chopped up? Why take the risk? What we do is clear the decks when the indexes break, when stocks, a lot of them, like I said, broke the 21. We use that as our short term, keep your money in the market indicator. And when it's broken, we get out of the way. It's really that simple, and wait for better days because you just look at late 2000 and look at how we trended in 2021. We're paying for that now, those gains. But every day that we suffer under these moving averages and wait for the coast to clear is another day closer to the next uptrend where we're going to be compounding because we'll be in the leading stocks when the market is at our favor. And there'll be a ton of stocks like Mobileye that we booked 20% gains on because they all act like this under the best of markets. And this one was the exception. It's very volatile. That's why we had a small position. We got up to 3%. When it broke below the 21 here, we went down to 1.5%. We caught this nice rally, made 20% on it. Not a significant gain for the portfolio because it was only 1.5. Sold half of it today or yesterday when just because we know it can fall apart as the market falls apart. You take your lead from the market. So still, excuse me, still quite a few above the 21, but like I said, not making much progress. You'll get a gap up and then it'll just go sideways. You get maybe 10%, 15% gains in some of these, but you're just as likely to wake up to a downgrade and a stock down 5% as you are to making any progress when you're in a bear market. So that's going to wrap it. As always, love to hear from you. Email don@revereasset.com or Dan, my partner, or phone 855 Real Wealth. Definitely check out the podcast with some good stuff on there this weekend between that grid that I went over, Alex's discussion on TMDX. Michael went through a couple of nice charts and explained a few things. Dan, as always, was spot on with his economic commentary, and I think you'll enjoy it. So definitely check that out. It's actually been released already on YouTube. You'll get the email tomorrow morning if you don't go to YouTube. So wrapping up the week ending December 16th, it's Don Vandenbord reminding you it's not how much you make in the market, it's how much of that you can keep. So stick with us here at Revere, just the facts here, no opinions. We follow what the market's doing, not what we want it to do. Thanks for listening and have a great weekend.